Usually when we talk about a technology revolution, we picture lines of code, right?
Right.
We
Yeah.
imagine these software developers in brightly lit offices just typing away, building things that are essentially invisible. I mean, software is supposed to be weightless.
Exactly. It lives in the cloud. It scales without taking up any actual physical space.
Yes. But then you look at what's actually happening right now with artificial intelligence, and suddenly that invisible code, it weighs thousands of tons.
Oh, completely. We've been conditioned over like the last couple of decades to think of tech growth as purely digital.
Right, a company writes an app, puts it on the internet, and 1 billion people use it.
Exactly. But we're looking at a technological revolution now that is honestly incredibly heavy.
Yeah, heavy is the word. It requires steel, concrete, massive power substations, and, literally entire lakes of water just for cooling.
It's the absolute definition of a paradigm shift.
Yeah.
We are officially transitioning from the idea phase of AI into, well, the concrete and steel
The
phase.
physical phase.
Yeah. We aren't just writing algorithms anymore. We are physically pouring the foundations for a new kind of global infrastructure.
Well, welcome to the deep dive. It is so great to have you with us today. For this deep dive, we've got a really fascinating stack of material, a comprehensive market preview that zeroes in on what is shaping up to be a massive week in finance.
Oh, massive is an understatement.
Seriously. And our mission for you today is to decode America's AI buildout. We are moving completely past the hype, past all those sci-fi promises of what AI might do in 10 years.
Right. We're looking at the ground reality today.
Exactly. We're tracking how billions in infrastructure spending by these tech giants is literally reshaping the broader economy, like how it's actually driving inflation and how it's fundamentally altering how everyday new businesses operate and hire people.
And it is all happening faster than I think most people realize. I mean, the sheer physical footprint of this technology is staggering.
It really is.
And the financial shockwaves, they're rippling through every single sector of the market right now.
Okay, let's unpack this because the stakes this week are just sky high. It is mega cap earnings week.
Yep, the big ones.
Over the next few days, we're going to get a look under the hood of Amazon, Apple, Meta, and Microsoft. But we aren't just looking at their profit margins here.
No, not at all.
We are tracking exactly where their money is going and how their capital expenditure habits are causing shockwaves that travel all the way from Silicon Valley directly to the Federal Reserve.
What's fascinating here is what we are seeing in the macro data, because the most surprising revelation from the material today isn't about, a new microchip or a faster algorithm.
Right.
It's that the physical construction of these AI data centers might actually be a bigger driver of inflation right now than global wars.
Which is just wild to think about.
It is.
But to understand how we got to that point, we kind of have to start at the top of the food chain, right?
We do. We have to look at the giants who are actually spending the cash, the Magnificent Seven.
Yeah, and we have a very fresh cautionary tale from just last week with Alphabet. They reported their earnings, and they handily beat expectations on the actual revenue numbers.
They did.
But their stock sank anyway. And when you dig into the balance sheet, the reason is glaringly obvious.
It's all about the spending.
Exactly. They drastically raised the projected expenditures on AI infrastructure. The market essentially punished them for spending too much money to build the future.
It's a perfect illustration of the tension in the market right now.
Yeah.
I mean, these companies are pouring just unprecedented amounts of capital into building these massive AI data centers.
Unprecedented.
And they aren't just using their cash reserves, right? They are actively financing the construction and operation of these facilities using debt and by selling stock.
And the investors are getting anxious.
Very anxious. They're looking at the capital expenditures and asking a very simple question. When does this massive outlay of cash actually generate a return?
Here's where it gets really interesting because the underlying dynamic feels exactly like a massive gold rush.
Oh, absolutely.
But right now, we are in the phase where the prospectors are going into massive, massive debt just to buy the shovels, the pickaxes, the wheelbarrows.
Right. They haven't found the gold yet.
Exactly. And they're terrifying their financial backers because they're spending billions on heavy equipment, but no one has actually struck a highly profitable vein of gold. They're just digging really, really expensive holes in the ground.
That is the perfect analogy. The market's patience is wearing dangerously thin. Wall Street doesn't just want to hear about how smart the AI is anymore.
No, they want the money.
They want to see the monetization strategy today. And that brings us to Meta reporting on Wednesday.
Oh, yeah, Meta.
Meta had a notoriously tough first half of the year. There was a lot of skepticism around their heavy investments in AI.
Compounded by all the usual government scrutiny they always face. Right?
Exactly. But their strategy has clearly pivoted. They've realized they don't just have to build AI for internal use. They can monetize the infrastructure itself.
Wow. Okay, how are they doing that?
Well, they're starting to make their own custom AI chips, for one. That gives them control over their supply chain and reins in those hardware costs.
Oh, that makes sense.
And they're also charging enterprise customers to use their latest, most advanced AI models. But the really clever move, the one that directly addresses that gold rush anxiety you mentioned,
Yeah.
Meta is reportedly launching a cloud computing business.
Oh, wow. So they are basically becoming a landlord for their own tech.
Precisely. And this is a massive shift. They've built this colossal computing infrastructure, and instead of letting any of those servers sit idle while they develop their internal tools, they're going to rent out access to that raw computing power.
That is brilliant.
It's a great way to immediately monetize the concrete and steel they've already paid for.
It makes total business sense. I mean, if you bought too many shovels, just rent them out to the other prospectors who are desperate to dig.
Exactly.
And that business logic actually validates the entire model Amazon pioneered with AWS, which is why everyone is closely watching Amazon's earnings this Thursday.
Oh, for sure. Amazon is perfectly positioned here.
Right, because they are already charging customers a premium to rent the specific high-powered hardware needed to train and run AI models. So they're directly benefiting from everyone else's AI ambitions.
Plus, they're coming off a very strong Prime Day.
Yeah, which keeps their core retail engine humming along nicely.
Amazon did have better than expected results last quarter, but their forward guidance disappointed investors a bit. So this Thursday, all eyes are on how much margin they can squeeze out of that AI hardware leasing business.
Because the demand for compute right now is just insatiable.
Completely insatiable. And Amazon is basically the toll booth.
So true. And then we have Apple also reporting on Thursday. Apple is in this fascinating position where they are just cruising on record highs right now.
Yeah, they really are.
They beat expectations last quarter, and there's this massive wave of excitement over their forthcoming devices. The iPhone 17s are proving incredibly popular, setting up a potential supercycle.
But even Apple can't ignore the AI arms race.
No, they can't. There is heavy market chatter right now about Apple potentially buying out an AI chip company.
Which is crucial for their long-term strategy, honestly.
Why is that?
Well, Apple relies on vertical integration. Relying on third parties for the most important hardware of the next decade is a vulnerability they just rarely tolerate.
Right, they want to own the whole ecosystem.
Exactly. If they want to run advanced AI locally on an iPhone without relying entirely on cloud data centers, they absolutely need their own specialized silicon.
Okay, rounding out the big four this week is Microsoft, reporting Wednesday. And like Alphabet, Microsoft posted better than expected results last quarter, but their shares slid.
Yeah, they did.
And I'm looking at Microsoft's slide, and it seems, I don't know, counterintuitive at first glance. I mean, they've been the poster child for AI integration with their whole OpenAI partnership.
Right.
My guess is the market is terrified that AI is actually going to cannibalize their traditional high-margin software subscriptions. Is that what we're seeing?
You've hit the nail on the head. That is exactly the anxiety playing out right now.
Interesting.
For decades, Microsoft's business model has relied on high-margin recurring software as a service revenue. You pay a monthly fee for Office, for Teams, for Azure.
The classic subscription model.
Right. But if AI fundamentally changes how we interact with software, or worse, if AI gets so good it can just code and deploy its own bespoke software for businesses on the fly.
Oh, wow. Yeah, that would be a problem for them.
It threatens the very foundation of Microsoft's legacy revenue streams. Investors are worried they're spending billions to build the very technology that will disrupt their cash cows.
Wow, eating their own lunch. Okay, so we have the Magnificent Seven spending billions, taking out debt, scrambling to prove they can monetize.
Right.
If we follow the money, if these tech giants are essentially taking out mortgages to build data centers, whose pockets is that capital landing in?
The suppliers.
Exactly. It's landing squarely in the laps of the hardware and chip suppliers.
The picks and shovels of the revolution.
Yes. And zooming out, these chip and hardware stocks have been some of the absolute best performers in the entire stock market this year.
Even with a little lost momentum very recently.
Right, despite that. And we've got a slew of them reporting. Qualcomm reports on Wednesday. They just struck a massive deal with Meta, and they are pivoting their business model hard toward products specifically designed for data centers.
And we have to look at why that pivot is happening. Qualcomm is facing sluggish demand for their traditional smartphone-specific chips.
Because nobody's upgrading your phones as much?
Exactly. The phone upgrade cycle has lengthened significantly. Consumers aren't rushing out to buy a new device every 12 months anymore. The growth there has just stalled.
Which makes sense.
Yeah.
And ARM Holdings is in a similar boat, reporting Wednesday. They topped expectations last quarter, and just like Qualcomm, they are moving aggressively into making hardware for AI data centers due to that exact same weakness in the smartphone market.
They're even planning to start selling their own chips directly.
Wow. We're also hearing from Seagate Technology on Tuesday, a major player in data storage who already raised their outlook back in the spring.
And Lam Research is reporting Wednesday evening they make the actual highly specialized equipment used to manufacture these advanced chips.
So it's literally a wholesale realignment of the semiconductor industry. The entire supply chain is pivoting.
It really is.
But let me push back on this strategy for a second, because I'm looking at this wholesale realignment and feeling a little skeptical.
Okay, let's hear.
If smartphone demand is sluggish and all these legacy mobile chip makers are suddenly dropping everything to pivot to data centers, aren't they taking a massive, desperate gamble?
How do you mean?
I mean, are they abandoning their core, reliable business just to chase the AI dragon? Because if the tech giants suddenly pull back on their infrastructure spending, these chip makers are going to be left holding the bag with nowhere to sell their inventory.
That is a very fair critique, and honestly, it's exactly the risk that bearish analysts are flagging right now. But if we connect this to the bigger picture, you'll see this isn't necessarily desperation on the part of Qualcomm or ARM.
Okay. What is it then?
It is an essential structural evolution. We have to recognize that the fundamental architecture of the internet is shifting. For the last 15 years, the internet was mobile first.
Right, the app economy. Everything on your phone.
Exactly. Everything was optimized for the low-power processor in your pocket. But the next 15 years, the architecture is going to be AI first. And you just can't run a massive neural network on a smartphone battery. The heavy lifting requires parallel processing, which means it has to happen in a massive data center packed with GPUs.
And the results just get beamed to your device over the network.
Precisely. Companies like ARM and Qualcomm aren't abandoning their core business. They're realizing that the core of global computing is physically moving. They're simply skating to where the puck is going.
Okay, that makes a lot of sense. The center of gravity is shifting from the device in your hand to a massive warehouse full of servers in the desert somewhere.
Exactly.
Which brings us right back to the physical reality of those warehouses. To understand why this is driving so much economic anxiety, you have to look at the chips themselves.
The power draw is insane.
It is. A traditional server rack might draw, 5 to 10 kilowatts of power? An AI server rack packed with those parallel GPUs training these models can draw 40 to 100 kilowatts.
It's massive.
You literally have to reinforce the concrete floors to hold their weight. You have to build entirely new power substations just to turn them on and run massive amounts of copper wire.
Right.
And this is where our deep dive pivots from tech stocks into global macroeconomics right to the doorstep of the Federal Reserve.
Because this is where the story gets really consequential for the everyday economy. The Federal Open Market Committee, the FOMC, they meet Tuesday and Wednesday of this week.
Yeah, with Fed Chair Kevin Warsh holding a highly anticipated press conference on Wednesday afternoon.
Right, and the Fed is widely expected to hold the Fed funds rate steady this week. But future rate hikes are absolutely still on the table.
We're also getting the Fed's preferred inflation measure, the PCE, or Personal Consumption Expenditures Index, on Thursday, alongside the Q2 GDP data.
But here is the crucial insight from the material today.
Yeah, let's get into it.
Several Fed officials are suggesting that the capital expenditure on AI infrastructure could actually be a more persistent cause of inflation than energy shocks stemming from geopolitical conflicts.
Wait, like the ongoing war with Iran?
Exactly. Let that sink in for a second. The construction of tech infrastructure is rivaling a major geopolitical conflict in its inflationary impact on the global economy.
So what does this all mean? Because the entire grand promise of artificial intelligence, the utopian vision we've been sold by Silicon Valley, is that it's going to make everything hyper-efficient.
Right. Cheaper, faster.
Exactly. It's supposed to drive costs down, optimize supply chains, make everything cheaper. Yet the sheer physical brute force required to build its infrastructure is so massive, so incredibly resource hungry, that it is literally out-inflating a geopolitical energy crisis.
It's a huge paradox.
Mhm.
And this raises an important question about the nature of inflation itself and the Fed's ability to fight it.
How so?
Well, we have to unpack the difference between temporary geopolitical inflation and structural inflation. When you have an energy shock, like what we are monitoring with the war involving Iran, that causes a sudden spike in oil prices.
Which we all feel at the pump.
Right. But those spikes, historically, are volatile and often temporary. In fact, global benchmark Brent crude just retreated 4%, falling to around $96.73 a barrel.
Oh, wow. It had crossed the $100 threshold just recently.
It did, but it fell rapidly because of signs that Pakistan is aggressively pushing to broker new U.S.-Iran peace talks.
Though it is worth noting, for corporate earnings later this year, even with that recent retreat, those earlier rise in oil prices are still threatening to squeeze profit margins across the transportation and manufacturing sectors.
Oh, they absolutely are. But again, geopolitical inflation goes up and down with the news cycle. What Kevin Warsh and the Fed are terrified of right now is structural inflation.
Because the AI build-out isn't going anywhere.
Exactly. The AI build-out isn't a temporary spike based on a headline. It is a multi-trillion-dollar, multi-year commitment by the wealthiest companies on Earth to consume massive amounts of materials, highly skilled labor, and electricity.
It's a sustained, unyielding drain on physical resources.
Completely.
And what makes it so difficult for the Fed is that these tech giants are practically immune to interest rates.
This is the scary part for the central banks.
Right, because normally when the Fed raises rates, it makes borrowing more expensive, which forces companies to pull back on capital expenditures, cooling the economy down.
That's the textbook response.
But Alphabet, Microsoft, Apple, they have such massive cash flows and such immense debt capacity that high interest rates just don't deter them.
None at all.
They just keep buying steel, copper, and electricity anyway, driving up prices for everyone else. Which means the Fed might have to keep borrowing costs higher for much longer, specifically because big tech refuses to stop spending.
Exactly. The traditional transmission mechanism of monetary policy is basically breaking down when it comes to the mega-cap tech sector.
And this brings us to a really important pivot. We've talked about the billionaires, the tech giants, the central banks grappling with these trillion-dollar issues.
A macro view.
Right. But how is this macroeconomic shockwave actually impacting the everyday consumer? Because you listening right now, you aren't building a billion-dollar data center.
Hopefully not.
Yeah, you're just trying to navigate a high-interest rate economy.
And the data we have on the consumer this week paints a very complex, almost contradictory picture.
Tell me about it.
On Tuesday, the Conference Board updates its Consumer Confidence Index. Sentiment did creep up a little bit last month, but the reality is that the public mood remains near historic lows.
People are stressed.
The average person is definitely feeling the pinch of sustained inflation and high borrowing costs.
Yet, when you look at the actual transaction data, people are still spending, but they are doing it in very specific ways.
Yes, the credit card data is fascinating.
We have the big credit card companies reporting this week. Visa on Tuesday, MasterCard on Thursday.
Right.
And just as a quick note for you listening, whenever we touch on policy proposals like the president's recent pitch to cap credit card interest rates at 10%, we are not taking a political stance here. We're purely looking at how the market reacted to the news in the source material.
Exactly, just the facts.
And in this case, credit card stocks initially took a tumble back in January when that policy was proposed, but they have completely regained that ground since then.
And the reason they regained that ground is really fascinating.
What's driving it?
One of the primary drivers for their continued growth is, ironically, the integration of AI. The data indicates that these credit card stocks could climb even further because consumers are increasingly embracing AI shopping tools.
That's interesting.
Yeah, these tools are streamlining the purchasing process, removing friction, and ultimately driving total transaction volumes up. People might be feeling pessimistic, but the AI algorithms are making it easier than ever to click buy.
I mean, I'm definitely guilty of that. And it's not just digital frictionless spending either. On Main Street, people are still showing up for their premium lattes.
Starbucks is having a moment.
Yeah, Starbucks reports on Wednesday, and their shares have climbed more than 20% so far this year. Their turnaround campaign is successfully driving physical foot traffic back into their stores.
Which is impressive in this economy.
Truly. We're also seeing earnings from Chipotle, the Cheesecake Factory, and Yum Brands. Across the board, these restaurants are still moving significant volume, proving that consumers are still willing to spend on dining out even if they claim to be tightening their belts.
We are also seeing a continued mainstreaming of digital finance. The S&P 500 just launched a new digital assets index that specifically excludes Bitcoin.
Oh, so it's looking past the big headline crypto.
Exactly. It points to a maturing institutional approach to digital transactions.
Hmm.
We're also tracking massive moves in the digital payment space, with PayPal shares spiking recently.
Due to the Stripe rumors.
Right. Intense rumors that Stripe is interested in acquiring them. The entire financial plumbing of the consumer economy is just being digitized and optimized.
Which brings us to the most fascinating shift in the consumer data, and it beautifully bridges the gap between everyday life and the massive AI boom we started with, the labor market.
The labor data is wild this week.
It really is. The numbers reveal that right now, Americans are actually starting more businesses than before. Entrepreneurship is up,
Wrong.
but they are hiring significantly fewer workers to staff those new businesses. And the data attributes this directly to the adoption of AI.
This is where we see the micro-level impact of AI happening right now, today.
Not in 10 years, but today.
Yes. While big tech is spending billions on concrete and steel infrastructure, everyday entrepreneurs are utilizing the AI software tools that already exist. They use it to handle accounting, marketing, customer service, copywriting.
Wow.
They are replacing what used to be entry-level human labor with a $20 a month software subscription.
So I have to point out this incredible contradiction for you, the listener, to chew on. On one hand, you have consumer confidence sitting near historic lows. People say they are deeply worried about the economy.
Very worried.
Yet at the exact same time, people are still shelling out for expensive coffee at Starbucks. They are running up transaction volumes on their credit cards, bolstered by new AI shopping tools, and they are aggressively starting new businesses.
Yeah.
They just aren't hiring human teams to run them.
What you're describing is a beautifully synthesized view of a decoupled economy. We are looking at a system that is pulling in opposite directions simultaneously.
It's dizzying.
It's redefining what a small business even looks like. I mean, think about it. A company of 1 or 2 people, armed with the right AI tools, can now generate the output that would have required a dedicated team of 10 just 5 years ago.
It's like the entire economy is being rewired while it's still plugged into the wall.
That's a great way to put it.
Let's take a step back and look at the journey we've been on in this deep dive. We started with Alphabet's warning shot. You know, the reality that even tech royalty gets punished by the market if their AI building costs get too high without a clear path to monetization.
The market wants returns.
Then we traced those billions of dollars flowing straight into the pockets of chipmakers like Qualcomm and ARM, who are realizing that the mobile era is maturing and this AI-first era requires a completely new data center architecture.
Skating to where the puck is going.
Exactly. We saw how the sheer physical reality of that concrete, steel, and power build-out is keeping Fed Chair Kevin Warsh awake at night. Because tech spending is proving to be a stickier, more structural cause of inflation than even international conflict in oil markets.
Which is just a historic shift in how we view macroeconomics.
It is. And finally, we landed on Main Street, seeing how AI is quietly reshaping everyday consumer spending through frictionless digital payments and allowing a new wave of startups to launch without hiring a traditional workforce.
It is a phenomenal amount of change compressed into a very short window of time. The infrastructure phase of a new technology is always disruptive, but the scale of this capital allocation is truly unprecedented.
It's massive.
And as we wrap up, I want to leave you with one final unexplored thought to ponder on your own. It's something that builds on this central tension we've discussed today.
Let's hear it.
We just spent a lot of time talking about how the building of this AI infrastructure, the copper, the power, the massive data centers, is causing massive structural inflation right now.
Right. The brute force demand for physical resources is driving prices up across the board.
But at the exact same time, we see that the application of AI, like those new startups we just talked about who are hiring fewer workers, drastically reduces operational costs and depresses wages.
Oh, wow.
So the question is, are we strapping in for an economic whiplash?
Oh, man.
Could we go from a period of severe AI-driven inflation today right into a period of massive, unprecedented AI-driven deflation tomorrow once all these data centers are fully online and the software begins replacing jobs across every sector of the economy?
That is the multi-trillion-dollar question. The tension between the inflationary cost of building the machine and the deflationary reality of what the machine actually does once you finally turn it on. It is going to be a wild ride. Thank you so much for joining us for this deep dive into America's AI build-out. Keep questioning the world around you, keep looking past the headlines, and we will catch you next time.